Ron Siegel Radio, your home and mortgage connection.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's Ron.
And hello again. Welcome to Ron Siegel Radio. This is the show with no real boundaries as we discuss current events, financial markets, politics, sports, even poking fun at the rest of the media. This is the show that connects the dots of confusion delivered by conflicting media reports. We connect the dots so you know the actions you can take, how your family or business can benefit in current events. Most of all, thank you for joining me. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day. We have a very focused show. We only chat about items that affect the roof over your head, your bank account, and anything I feel would benefit you. But before we get into our intriguing content today, please join me in welcoming our featured guest and repeat offender on Ron Siegel Radio. Our favorite no-tax guy, Todd Halterman, is in the house. Welcome.
Good morning.
Glad to have you with us. And let me remind you, if you ever have any more finance-related questions, I am the consumer advocate looking out for you. And you can reach out to me directly, 800-306-1990, 800-306-1990, or ronsiegelradio.com. Just remember, that's the number you call anytime for assistance. When you call that number, it comes directly to me first. There are operators standing by.
Quiet, numbskulls, I'm broadcasting.
While I do have a great team when it comes to developing a financing plan, a plan to save you money, I personally work with you. Even if you don't have any needs today, save this number in your phone for future reference. 800-306-1990, 800-306-1990. And yes, we are celebrating today. But for most of you, we are celebrating at a low pitch because some of us might have had a little extra to drink yesterday. And that's why we call today National Rehydration Day, not dehydration. That was yesterday. Today's rehydration, also known as National Football Hangover Day. Josh, we should put a question of the day. Should the Monday after the big game be a national holiday? You know, I think that's a good question because there's a lot of people that are dragging. And I'll submit, in a lot of businesses, I wonder how far down productivity is the day after the big game. Should Monday after the game be a holiday? Yes or no? If you're listening to us on ronsiegelradio.tv or any of our socials, put it in the comments. Yes, all you have to do is yes or no, Y or N, thumbs up, thumbs down, whatever you like. If you're listening to us on ABC News and Talk on their terrestrial radio, AM or FM, or their video stream, yell at the radio, we will hear you. It's pretty simple. So we've also got National, this is a good one, Bagel and Lox Day. Now, if I look at the graphic, now Josh has the graphic a little closer to what should be. Closer. Now, I personally prefer an everything bagel, but you've got the cream cheese, the lox, the capers. I don't need all the other fancy stuff. And if I have my option, Palm Desert, Sherman's Deli. That's where I'm going because, and you know something? I do indulge there quite frequently. It's also National Pizza Day. Now, I had to get educated this morning because, I thought pizzas, that would be something that would be for the big game, but I guess it's wings. Now, how many wings do you have to call it a meal? I know when I was younger and ate more, you have to have a lot of wings. Now, I did have some, I will admit, now this is a family show, but Añejo tequila, Comisario was my favorite. So not that I get paid from Comisario, but they have been on the broadcast with us. In fact, Josh, we should put a note, send me a telegram to reach out to them for Cinco de Mayo. And maybe we'll have them come on and do a little taste test for Cinco de Mayo on Comisario tequila. Nice. Cut the cord day. I don't know about that one. Okay, well, let's move right along and see what's going on in the world to get back to our broadcast here. Wait a second. We did miss it. Anybody make any money on the Super Bowl, on the game? Oh, sorry, the big game. I guess they don't like us to call it anything other than the big game. So I felt that last 2 weeks ago, whoever, and I know there's going to be a lot of people that aren't going to like me to say this. I think the game 2 weeks ago was going to determine who was going to be the winner of the big game. I think the game between the Rams and the Seahawks, whoever won that game, I thought would win it all. And Seahawks took it. I didn't think, and I think that, ironic enough, Todd, I want to get your opinion on this one too. Was the Patriots totally outcoached? I mean, McDaniel had no answer for the Seahawks defense. Their defense was great, but McDaniel had no answer. What do you think?
They came at him from different ways. That young man behind the center just doesn't have enough experience to get around the way they swarmed him. And he got sacked when a lot of times you seen Darnold get out of it or throw it away but not get in trouble for it. That's the difference between a 15-year vet and a 2-year quarterback.
Yeah. And you know, even with that, I mean, having two rookies on the left side of the offensive line, you know, nobody gives the line the credit that they're due. And, you know, I would say that Tom Brady couldn't have been Tom Brady without the offensive line he had.
Of course.
Right?
Look at the dynasty the Denver Broncos had because of all the stinking room they had to run that ball.
Yeah. I mean, they don't get the credit that they should, but I could talk about that game, you know, for a while. But let's get to the market. The Dow Jones Industrial Average up 13. It's finally turned around this morning. The NASDAQ up 267. S&P 500 is up 48. Oil, that's up $1 a barrel, 64.56 a barrel. And I'm going to throw this at, I'm not going to throw it at Todd because I don't like predictions from licensed people. But my personal opinion, and I don't hold the license, gold right now would not be someplace. You could give me the physical gold, but I'm not investing in gold at $5,064 an ounce when it was $2,700 an ounce a year ago. Too big a rise for my liking. I think there's other places that might be a little bit more secure. And I know gold is always looked at as a secure investment, but you know, when it's doubled in a year, that which can go up double in a year, I think can go down the same percentage in a year. And, you know, just be careful right there. And that's just coming from the guy who's been involved in the markets for 50 years now. I know some people that are listening to us haven't even been alive 50 years, but yeah, I did start investing in the markets long time ago. We're looking at the spread between the 10-year treasury and the 30-year fixed rate loan. Had been running at 2.5. Historically, it's a 1.79. If you look at the 10-year treasury right now, 4.2. If you use Mortgage News Daily as a reference point, as of last Thursday, it was 6.15. So you're looking at 1.95 is that spread, if my math is correct. So it's compressing right there. So we're watching on that one, which is a good thing, especially in light of the idea that China government is telling the Chinese banks that they shouldn't be buying or watch out or diminish their holdings on the U.S. treasuries. So watching all of these things for you. You are listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. We're going to talk to Todd Halterman today because if you haven't noticed, there's a lot of chaos in our world. And we're going to see if there's maybe some ways to make some sense of the chaos or make some money from the chaos. We'll talk to Todd about that. Why townhomes are popular with today's first-time buyers, what bad credit really costs you, and more. Reach me anytime. Off-air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the number 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Are you a veteran, own a home, and need money? The Siegel lending team is here to help veterans refinance and get the money they need. The VA 100 lets you borrow up to 100% of your home's value, refinance your mortgages, consolidate credit cards, and lower your payments by an average of $700 a month. And the Siegel lending team knows that character means more than a credit score. Call 800-306-1990. That's 800-306-1990. Rate subject to change without notice. Licensed by the California Department of Corporations, NMLS 21037, and DRE number 018694452. You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio or anytime at 800-306-1990, 800-306-1990. Mortgage Minute today being brought to you by rsrlinks.com/mobile app. rsrlinks.com/mobile app. And every day at this time, OBMMI, they provide the most comprehensive, accurate, timely, and interactive analysis of pricing ever conducted in the mortgage industry, calculated from actual locked rates with consumers across 35% of all mortgage transactions nationwide. They don't tell us points paid, points received, or the APR. They tell us the number you need to put in your mortgage calculator to determine if what your principal and interest payment will be. And if you do not have a mortgage calculator, well, shame on you, because we've got a dashboard of about 60 calculators. And some of these calculators, we have to even show you how to use them because they are very, very advanced wealth building calculators. A retirement analyzer. How about that one? I think we'll probably analyze that one for our weekly report this time. Talks to you, shows you how to analyze whether you're on track or off track for retirement with whatever your goals might be. But let's take a look and see what the numbers were on Friday. We've got a conventional 30-year fixed mortgage was at 6.083. That was down. Jumbo 30-year fixed, 6.214. That was down. FHA 30-year fixed, 5.941. That was down. VA 30-year fixed, 5.703. That was up. In the USDA 30-year fixed, 5.955. That one was down. And if you want our thoughts about the market each and every business day morning, as early as the data allows, join the Ron Siegel Radio community. It is free to you, rsrlinks.com/HBOD. So what are the markets doing today? Well, the S&P 500 is up now 49 points. 10-year Treasury is down just a little bit, 4.205. We've been fighting that 4.2 on the 10-year Treasury for quite a while now. And we're also looking at the mortgage bond. That is flat right now. So nothing happening on the mortgage bond. Now, as I've shared with you before, everything I just told you is available on the super secret website, google.com. Or if you don't use google.com, ChatGPT, Gemini, Perplexity, or any of your other AI sources. What's driving the market is not on there. So we've got a Bureau of Labor Statistics report coming out on Wednesday. And as you know, I refer to that as the BS report because they get it wrong every time. Yeah. There was also a story overnight from China that could have an impact on the Treasury demand. China's advised their financial institutions to limit purchases of U.S. government bonds and instructed those with high exposure to pare down their holdings. This does not apply to China's state holdings of U.S. Treasuries, but can still have a material impact on demand. So you've got three institutions all going through things there. You've got the Chinese government, which is not the same as the Chinese Communist Party. And then you've got the banking system. So you've got three different groups there. Impact is yet to be seen. It could be another reason to speed up bank deregulation. Something Scott Besson is working on. This would allow banks to purchase treasuries with the reserves and an additional yield. And it would also be a big source of demand for treasuries. Now, I think it's kind of ironic that they limit how much treasuries the banks can hold, because when I was a financial advisor, licensed as a financial advisor around the turn of the century, the only thing that we were allowed to say that was guaranteed in the world of finance was U.S. treasuries. Nothing else could be referred to as guaranteed because it was U.S. Treasuries are backed by the full faith of the U.S. government. So, and I'm assuming that's probably still the same today. Is the only thing you can say is guaranteed is the Treasuries. So let's see what's going on further. BLS is going to release their delayed January jobs report on Wednesday, January Consumer Price Index report on Friday. Market's expecting 70,000 jobs to have been created in January. Pretty high bar, especially considering the recent string of labor data. ADP showed 22,000 jobs in January. Revelio published a negative 13,000, and job openings fell sharply in December. Everything is pointing to a weak number, but we know that the Bureau of Labor Statistics is always unreliable. BLS did say that they were reworking their birth-death model. Surprise, surprise. We've only been asking for that.
Surprise, surprise.
Asking that for a long time. This is where they estimate small business growth based on historical openings and closings of businesses and how many jobs that accounts for. It's the main reason the BLS overstates jobs, which is then corrected with QCEW. If they do a good job, it's another reason that the numbers should miss. The unemployment rate is expected to remain at 4.4%, but we would be surprised, or we'd not be surprised to see that rise. Lower jobs figure and or higher unemployment rate should help the bond market and rates. Friday's CPI report will also be key. The last reading for December was 2.7% year over year, while the core was 2.6. Remember, Trueflation is 1.3, 1.8%, and they're using real-time inflation numbers. January 2025 replacement figure will help us as they're 0.47 for the headline, 0.45 for the core, meaning they are high numbers and easier to replace with a small number, making progress year over year. The estimate ranges are pretty wide. Headline 0.13 to 0.3%, and core of 0.22 to 0.3. Based on that, headline is expected to improve from 2.7 to 2.4 to 2.5. Core is expected to decline from 2.6 to 2.5. Shelter always plays a big role as it makes up almost 45% of core. The replacement figure from January 2025 was higher at 0.37, while the recent monthly numbers have been coming in lower. Additionally, lodging away from home hurt us in December, but there is more travel and hotel pricing pressure that month. It's reasonable to believe that January will see a pullback where lodging may help us. Bottom line, we think core, which is important, could come in at 2.5 or maybe even 2.4. ICE released their latest housing report, not the immigration group, showing that home values rose slightly by 0.04% month over month in January and rose by 0.6% in 2025. ICE has been a bit lower than other appreciation sources out there. They also explain that 1.3 million recently originated mortgages have rates between 6.875 and 7% that are very close to being in the money, and that a small improvement can cause an uptick in refinance activity. If rates were to fall back to 6%, they estimate that there are 5.5 million available refinances where the homeowner could save at least 0.75% in rate, 80% LTV, and have at least a 720 FICO score. So, remember though, when each time we've seen mortgage rates drop, it's only been short-lived. So be careful of that. That's the Mortgage Minute, brought to you by rsrlinks.com/mobile app, rsrlinks.com/mobile app. So let's bring in our friend Todd Halterman with us this morning. He is a financial advisor, licensed to do all those good things. Not giving us financial advice today. He is here as an educator. So if you want financial advice from Todd Halterman, that's what he does for a living. You can call him, you can retain him, you can email him, send him smoke signals, any of those things. There's a lot of ways of reaching Todd, but remember, we're not giving any of that advice today. Good morning, Todd Halterman.
Good morning, Ron. Thanks for having me today.
So tell me, what are you thinking about this market and all this chaos and everything else that's going on?
Well, money's made globally when there's chaos, Ron. As you know, when there's risk on the table, there's money to be made. I can tell you that every fundamental indicator that we track with our analysts is saying this bull market run is not concluded. We are not frothy on the top. There is so much demand given global policies right now in everything from energy infrastructure to energy itself, to the opportunity with rare earth metals, to the financials, You know, you start looking around the globe, there's not enough money being spent with defense companies. There's not enough money being spent in cybersecurity. There isn't enough money being spent in markets of just construction. I mean, the trade tariff program has forced so many different countries to develop business plans to build manufacturing in America. And our bridges, highways, and roads are already in horrible shape, Ron. So we've got to put Americans to work. We got to get the trades to work. We got to build our energy infrastructure. It started out as a semiconductor race, then it turned into an AI race, and now it's a full-on energy race. And you can't have energy without metals. And I will tell you that the gold market is very high, but the fact is the global government consumption and the utilitarian use of gold, I'm going to tell you, I believe gold will go to 10,000 in the next 3 years.
Wow.
But I will tell you this is a dangerous time to get in because these gold runs, these metal runs always have a 25% correction somewhere in the middle for it to breathe off that energy and then go to new heights. We had a small pullback here recently, but here's reality. All the gold and silver mining companies around the world are expecting, 3,500 to 3,900 gold. And that's what they price their balance sheets. That's what their stocks are priced at. And they're putting out so much metal right now on their mining operations, and the demand is so high. These mining operations are putting out record profits. Silver, for silver miners, they're priced between $60 and $75 an ounce on their balance sheet right now. So these miners and the mining operations look very productive place to park money if you want exposure into an opportunity in the metals market without buying gold at 5,600.
That's one of the beauties of having you come on with us, Todd, is you're always giving us, the headlines are always great, but the money I think is made in knowledge, and it's the underlying areas that fit into that. When we come back, I want to chat with you further about one of the things that we've seen is that, the last 2 or 3 years, the S&P was driven by, or the S&P 500 was driven by 7 stocks.
Yes.
Now we're seeing that it seems like it's a much wider playing field. So I want to talk to you about that when we come back. You're listening to Ron Siegel Radio, discussing your real estate current events and the financial markets. Reach me anytime off air number 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you missed any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Confused about the home buying process? Or curious how much you really know about buying a home? Take the First Home IQ quiz to test your understanding of buying a home. Created by the nonprofit First Home IQ, this 5-minute quiz will give you a score, what you missed, and why. Take the quiz in 5 minutes at rsrlinks.com/FHIQ and find out what you need to know about buying your first home. That's rsrlinks.com/FHIQ.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's
Welcome back to Ron Siegel Radio. Within every market, there are solutions, as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio, or anytime at 800-306-1990, 800-306-1990. Real-time real estate segment today being brought to you by rsrmoney.com, rsrmoney.com. Why townhomes are popular with today's first-time home buyers. Buying your first home can feel frustrating when the numbers don't line up the way you expected. You may know you're ready, but finding something that fits your life and your budget is the hard part. That's where townhomes come in. Townhomes are becoming a bigger part of today's housing supply, and that shift is opening doors for first-time buyers in a way we haven't seen in years. That's because they offer a more realistic path to step into home ownership without stretching yourself too thin, especially in a market where affordability can still feel tight. Builders are building more townhomes than they have in decades. In fact, when you look at data from the National Association of Home Builders, Nearly 1 in 5 new single-family homes being built today is a townhome. That's the highest share on record. And you're seeing a graph if you're watching us on RonSiegelRadio.tv, any of our socials, or the ABC News and Talk AM 1490 or FM 98.1 video feed. You're seeing a graph of nearly 1 in 5 townhomes being built are townhomes. And you can see where that percentage has gone to. To put that in perspective, just a decade ago, townhomes made up closer to 1 in 10 new construction homes. That gives today's buyers far more townhome options than they had in the past, and that's a really good thing. Townhomes are one of the best ways for first-time buyers to finally get their foot in the door, and seeing that there's more available for sale means one thing. You may have more opportunity to break into that market than you think. Here's why there's such a popular choice for buyers like you. While prices vary by market, Redfin data shows townhomes are typically priced lower than detached single-family homes nationally, and that gap has grown in recent years as the supply of this type of home has grown too, and we've got that chart for that one as well. There are 2 main reasons you may find a better deal on a townhome today. Reason number 1, townhomes are usually smaller by design. Most modern townhomes fall in the 1,300 to 1,500 square foot range, which helps keep prices and monthly payments lower. Basically, it works like this. Since they usually have a smaller footprint, they're cheaper to build, and that makes them less expensive to buy, too. Ali Wolf, chief economist at New Home Source, explains how this helps buyers. Quote, with the high cost of housing across the country, townhomes have emerged as a vital, more accessible entry point into home ownership. They're often priced lower than detached houses, offering buyers, especially first-timers, young professionals, and those downsizing, the chance to build equity without breaking the bank, unquote. Make sure you get the first-time home buyer's guide that we've been putting out and publishing, rsrlinks.com/FTHB. rsrlinks.com/FTHB. Reason number 2 is builder motivation. Here's another thing working in your favor. With more inventory than in recent years, home builders are motivated to sell what they've already built. So many may be more willing to negotiate, whether that means price flexibility, closing cost help, or potentially throwing in upgrades. According to the National Association of Realtors, quote, home builders say they're ready to attract more first-time home buyers. They're responding to affordability pressures through lower cost homes and builder incentives. About 40% of builders cut prices on newly built homes at the end of last year. Roughly 2/3 of builders also offered additional incentives like mortgage rate buy downs, unquote. Now, remember 2 things here. Number 1, you're more, it's much better for you to get the buy down. rsrlinks.com/buy down. rsrlinks.com/buy down to learn about that. Take that instead of the price cut. Then you can call somebody like our team and ask them if they can overfinance the property. Most people haven't heard of this. Overfinance the property. Think about doing a home renovation loan on a new build, because you're going to have to do renovation work. You need to do hardscape, landscape. You might need to do upgraded flooring and countertops and things like that. So the home renovation loan, which nobody talks about, in conjunction with a rate buy down and builder incentives, it looks like a grand slam to me, being that football's over. Bottom line, if buying your first home feels just out of reach, the right option might not be a different timeline. It might be a different type of home. You want to talk through whether a townhome makes sense for you or see what's available in the area, give me a call, 800-306-1990, 800-306-1990, or RonSiegelRadio.com. So let's continue our conversation with Todd Halterman, financial advisor du jour. And we were talking in the last segment. Todd, what you were sharing was a great prelude to our real-time real estate segment, in the sense that, the townhomes require less independent building materials. And you were talking before about having to find alternative building materials because of all of the chaos in the world. Kind of fits right in, doesn't it?
Oh, it does. I mean, I live in a townhome. I'm a townhome dweller.
Yeah, and it makes sense because, some of us don't want to deal with all the gardening and all the exterior maintenance and all that, and, have a little freedom. I think as a first-time buyer or as a seasoned individual, we don't, you and I, we don't have kids at home and all that. So we need to have room for the grandkids, leave the kids home. That's better if we get the grandkids and leave the kids out and have space like that. And I agree completely. But I want to get back to the thought and get your input on this. The last few years, it's been the Magnificent Seven has been all the talk, all the hype, and for good reason. And the S&P 500 has been driven by those 7 stocks. But there's 493 others that seem like they're in the game now. Was that right, or am I just hallucinating?
No, not at all. I mean, we're seeing the turnover happen. Last year we were encouraging investors to invest in the equal weight S&P 500, where the Magnificent Seven don't control the top 30% of the market cap of the S&P. But, for the same reasons that the market was being carried by those 7 companies is the reasons the market has been having a lot of turbulence, a lot of additional volatility. When Microsoft and Google and Amazon are all talking about the billions of dollars they're going to continue to spend to develop their energy infrastructure, to supply their AI demand needs and their data servers, then these stockholders don't like that. In fact, if you look at Microsoft and Amazon, they've been fairly flat the last year. Google's gone up 67%. But I'll submit to you, Google's got 5 different silos. And if you valued each one of those silos, Google will be worth double what they're worth today. And that might be a hint. But the reality is the market's not done moving. However, we're seeing all kinds of infrastructure and sectors rotate into the growth mode because there's a tremendous amount of global spending happening in key industries and markets. And Ron, if you closed your eyes right now and said, 10 years from now, how much bigger is the cybersecurity business? Yet the cybersecurity business, the index is down almost 20% in the last 6 months. Who knows that? This is a fantastic time to buy into a marketplace that can do nothing but add to their cybersecurity protection. Quantum computing, defense spending in drones, unmanned underwater vehicles. We start talking about the infrastructure we need in this country in America just to build out our power grids. If an investor just chased the energy markets and the infrastructure, and I'll call it the pickaxe and shovel investments of the gold rush, you don't have to chase the gold here, Ron, to be sustainable. And people need to pay attention because there's money being made in a lot of markets, and it's not the Magnificent Seven.
So, Todd, in the past, when you've been on the broadcast with us, you've talked about some of these dual direction funds.
Absolutely.
Can you get involved in those can you pick and choose, like in the infrastructure that you're talking about, or do they just do whatever they want to?
Well, you can pick index. These are called buffered ETFs. So the commonality of buffered ETFs are coming out more and more in the institutions, but a lot of your retail investors don't know about them because these instruments used to only be used for large pensions and institutions and municipalities and governments. But today, through buffered ETFs and insurance trusts, people can maintain their investments to be liquid. That means they don't have to tie them up. They can set an agenda to invest in an index, where it's the European EFA index, the Russell 2000, the NASDAQ, where a lot of the technology companies are, or even the S&P 500. But if you have a dual direction buffered asset, when the market goes up, you get 100% of what the market makes up to a cap. If the market goes down 15%, though, in a year, an investor can protect their principal and actually make 15% while the market's going down. So a lot of investors have all this money in the market and they don't know how to defend themselves. And we are using the dual direction buffered ETFs to help investors, when the market does turn, not have a loss, actually have a gain.
I like that idea because we've talked about this before, and I'm not the quickest on the math, but I'm going to do it in easy math. So when you're talking about the market's been going crazy. I mean, and the markets never ever seem to, at least in the history I've watched and studied, they don't always, they go up over time, but there's always, points in time that they're not going up. Maybe it's a year, maybe it's 2 years, or it's, one sector's out of favor, or the S&P's out of favor in favor of small cap or something. So when you get and I'd like to use this math because it's easy and I'm a simple guy. If the market is, you got $1,000 and the market corrects 25%, you said 15, but I'm going to use 25 because the math's easy. It goes down to 750. But you've got to go up 33% to get back to your 1,000.
Correct.
So when you have that dual protection in there, you know that now you get it where it went up nothing, so you're still at your 1,000, and it goes up 33. You're at 1,300 instead of just getting back to even. That's a big benefit.
Yeah, it's a compounding issue that people don't understand the math, that you've got to make more on the return than you do the up. So if your neighbor is at 1,000 and down to 850 because the market corrected 15%, yet your portfolio is sitting at 1,150, your neighbor is going to have a hard time catching you in your buffered ETFs over time. So the reality is, if you can lose less and compound your returns by going up while the market's down, we usually will help clients take some of their winnings off the table and defend it. So when the market does turn, and it will, and I'll submit there should be a wild ride later this year. There could be a huge correction this year based on a few different things, but you have to understand that's coming. So defend yourself. Don't just keep doing the same things you've been doing over and over again. That's a definition of insanity. Protect some profits, get some dual direction, and hedge some of those risks.
So when we come back, I want to talk to you a little bit about asset allocation, if we can. Again, not from any kind of a specifics, but general educational purposes. If we can. You're listening to Ron Siegel Radio, discussing your real estate, current events, and the financial markets. You can reach me anytime. Our off-air number, 800-306-1990, 800-306-1990, or RonSiegelRadio.com, Facebook.com/Ron Siegel Radio. And if you miss any part of our broadcast, Ron Siegel 1 on YouTube, Ron Siegel, the numeral 1 on YouTube. Stay tuned. We'll be back in just a few.
Ron Siegel Radio. Your home and mortgage connection.
Do you know a homeowner experiencing divorce? Do you know a real estate reference and the divorce decree could cost tens of thousands of dollars? A certified divorce mortgage planning and real estate report could save you thousands of dollars, and it's free from your local certified divorce lending professional. Reach out to Ron today. RonIsMyLender.com. Again, RonIsMyLender.com. Licensed under NMLS 217037, Equal Housing Lender.
You're listening to Ron Siegel's Home and Finance Show with local and national expert Ron Siegel. Now, here's...
Welcome back to Ron Siegel Radio. Within every market, there are solutions as well as tremendous opportunities. You just need some trusted guidance. That is my message, and I will be delivering it every day on Ron Siegel Radio. Or anytime at 800-306-1990, 800-306-1990. Borrow Smart segment today being brought to you by GetHomeSelect.com. GetHomeSelect.com. Still the best loan on the market if you want to, see an interest rate, an effective percentage rate below 2%. The best loan on the market. Now, we are working, and I know I've mentioned this before, but probably within the next 3 to 4 weeks, we're going to have an announcement on our VA book. So if you're a veteran listening to this, got a whole book coming out on the veterans loan. So you're going to want to make sure you're tuning in on a regular basis. But I talk a lot, so I want to get back to Todd Halterman. That's the Borrow Smart segment, brought to you by GetHomeSelect.com, GetHomeSelect.com. So Todd, I want to chat a little bit because, again, I was licensed at the turn of the century with Series 7 and 66 and insurance licenses and all that good stuff. And we spoke a lot way back then about asset allocations. And I think a lot of people might have gotten a little heavy just chasing the grand slam of what the Magnificent Seven has been and gotten away from some of the fundamentals of the market. And I'm sure that I know back then they had these scattergrams. I'm sure that somebody's still putting them out today where you can see which charts or which sectors are doing best over the last 10 or 15 years and which ones went to the bottom. It used to be that you never saw the same sector on top very long. But the way to kind of protect yourself was using asset allocation. Is that still something that you're recommending these days?
Well, yes, and a matter of fact, it's more important now than it's ever been because a lot of investors watching TV and watching the stock market news have been tilted heavily to technology and technology driven investments. So, again, it started with semiconductor chips, and then people started gravitating towards AI companies, and then they realized the AI companies are having to source power. So now you see people going after energy markets, whether it be solar or more traditional oil and gas, which we've seen that price come down steadily. But the reality is, this energy race isn't just about power; it's about building out the energy grids that are needed. So asset allocation is more important now. So when we see people come in that are tech heavy, we're like, we need to build up your construction and industrial investments. This is a fantastic time to be adding real estate into a portfolio with pending interest rates coming down. And the market has been on a resting spot for the last 3 years from 500% interest rate increases. So these real assets, commodities, real assets with real value, with real collateral is where people should be turning over their portfolio to get away from that technology heavy allocation that everybody's become addicted to.
So it kind of scares me there, Todd, and I think a lot of people, because we've gotten heavy into the tech. Unfortunately, there's a lot of us that have Microsoft, and I think it's down 25% in the last month or two, or 20%. And you start looking and you're saying, do I want to just dump it all at a fire sale, or am I better off, stepping out over time and diversifying? What's the best way? And again, I'm not asking you for stock picking advice, but I want global advice on
Sure.
how do we migrate from one to the other and not lose. Maybe we haven't hit everything or achieve the maximum value from our Microsoft and Apple and Google and all those.
Well, I tell folks that we can allocate about 15 to 20% of a portfolio overall from asset allocation to be aggressive. That means when you see a beast of industry like Microsoft go down 20 to 25% and their multiples are there, it's time to buy Microsoft right now. And the hardest thing to do is to buy something that has fallen. And the reality is, when people are afraid of something, it's usually the time to buy it. Apple is another one of those companies who has not been recognized for where they're at in their business cycle. And in our opinion, Apple is in a very advantageous price to buy the dip, if you will. So there's opportunity out there, but you have to have a plan, Ron. And the plan needs to be, don't take those incremental risks with your entire portfolio. Peel 20% out to do your wild cards and your enjoyable things, because if 20% goes to 10% because you lose half, you're only off a 10% allocation in your entire portfolio. But you need to build beasts of industry. Another beast of industry is Rockwell Automation. Rockwell Automation is at the center hub of manufacturing and automation efficiencies for all of manufacturing. So there's tremendous amount of opportunity to find awesome companies that are huge with big cash reserves, and they have an economic moat a mile wide, which is a compelling advantage against their peers. But if you don't diversify, this technology market is going to correct 30 to 50% at some point because their valuations are way too high and they're not making enough money. And if you don't hear that, you're going to regret it later this year.
So do you just say sell it cold turkey, or do you stage out?
I stage out. I raise cash mildly, but with a Microsoft or an Amazon, especially in the market cycle right now, it really depends on the asset. But that's why you need a plan. And you need some trusted guidance from somebody who's not emotionally attached to it and who can tell you, well, no emotion, this is where you should rebalance. And I'll give you an example. 4 weeks ago, I went through and I peeled 50% of Palantir out of almost every one of our clients' portfolio. And they're like, why are you doing that? I said, because Palantir is going to go to 130. They are going to correct, and they're a nice stock to buy at 130. But I want to harvest some of your profits, and I want to invest in companies like Rockwell Innovation or Symbotic Robotics or Teradyne or Black Sky or AST Space Mobile. There's so much opportunity, but you've got to stick to your discipline to rebalance, take some of those winnings off the table. And if you don't, hey, Ron, I know you don't have a lot of hair, buddy, but even if you don't cut your hair, it's not healthy.
Yeah, and something. One of the things I know that You're the king of disinheriting the IRS.
Amen.
A lot of us have big capital gains in those stocks. How do we deal with that part of it?
Well, there's a couple of different ways you can deal with it. We can actually work on a thing called direct indexing, which helps create losses in your portfolio so you can slowly reduce your position over time. Or we use different types of trusts to protect people. That means when you sell a highly appreciated asset, you don't have to pay taxes when you sell and you can rebalance. But there are several ways to do that. Everybody's different because their tax return is made different. But I would say 65% of the meetings I'm doing today is helping people with huge positions in Palantir, NVIDIA, all these different market flyers, and we're chopping them down and having them not pay tax at all. And if they do pay some tax, it's very little.
Well, so that's a huge thing, because if you've got a lot of capital gains, just like we talked about the idea before, if the market goes down 15%, well, most of the time, I'm not the tax guy, but capital gains are 20% or something on a federal level. And if you're in California, they want the other 80%. But I jest there. I know California's not at 80% tax, but it's way too high.
Sure feels like it.
Yeah, it feels like it. Exactly. So, you're that much further ahead if you can do that in a strategic tax environment.
Correct. Proactive, but you have to have a plan. And unfortunately, Ron, you and I both know it. We've talked about it for a decade. A lot of my peers are investment managers. They're not real planners. They execute, they hold. But once you have a financial problem, then you don't have a plan, then you have a problem. That's the difference on how we approach making sure we have proactive plans in place to make sure you disinherit the IRS and keep more of the profits you make.
And that's another big issue that we've talked about in the past on Ron Siegel Radio, is the idea that, the CPAs are very, very good reporters. They're not strategists. And I'm going to submit a lot of financial guys and gals are not tax strategists either. Their job, and they're listening to their upper management who's saying, okay, go buy this or go buy that, or this is what we're pushing today, or this is the fund that we want because it's got our own company name on it. And they're not promoting that other 30%, between state and federal that you're talking about right here. And that's one of the things you do as a financial guide, aren't you?
Well, yeah. I mean, my job is to help teach people corporate family structure and help them build the way to protect themselves from liabilities. But on top of that, Ron, a proactive CFO for families to help teach their entire family how to build the structure so their CPA says, oh, yes, we can do that. But CPAs by nature are underwriters. They're trained to say no. They're trained to protect you. And they only do what they know and understand. And many times they get stuck in their practice with 1,000 clients tax preparing. They don't have enough time or bandwidth to talk to you extra to say, oh, if we did this or we did that, because they don't know how to bill for it. And those days are over with the people I work with, because the first thing we do is we say, how can we do better? And then we have a meeting with their CPA to say, why not?
Yeah, and sometimes I'm going to submit, because I know it's hard for you to say this, but you might have to change CPAs, right? Because some of them, they all know the answer to everything. And they are, like I say, they're very good at reporting, but they again, like you said, they don't have the bandwidth to do it all. And, nobody really can do everything. And my line is it's hard to catch two rabbits. Right? So if you're trying to catch two of them, you're in trouble. Hey, if you want to meet Todd Halterman, if you want to get a consultation with him, give me a call at 800-306-1990, 800-306-1990. I know how to send him the smoke signals that he answers. So just give me a call. I'll put you in touch. And again, 800-306-1990. Thanks, Todd Halterman, for joining us, sharing some of your wisdom with us. And as always, we ask, set that first radio preset button to come back here and join Ron Siegel Radio, where we only speak about items affecting your house and your bank account. Thanks to all of our sponsors. A big thanks to Josh and Sean for engineering us today. And of course, a special thanks to you for spending a little bit of your day with us. That's all for Ron Siegel Radio. Again, if you have any questions or to meet any of our guests, call me anytime, 800-306-1990, 800-306-1990, or RonSiegelRadio.com. And remember, make a lot of money, so you help a lot of people and have a lot of fun. Have a great day. We'll talk to you next time on Ron Siegel.